afternoon, Trinidad and Tobago, and welcome to the Bourse Report. Excuse me I'm a little bit under the weather, but that's okay. Business must go on. And today we're taking a look at some financial results from the financial sector and non-banking finance sector. We're speaking, of course, about NCB Financial Group for its fiscal half year ended March 2024, as well as Guardian Holdings Limited for its first quarter ended March 2024. Now, both groups would have had, or both companies rather, would have had varying fortunes in terms of their financial performance. Let's take a look at how both of them would have done and what investors might expect in the coming months ahead. Turning firstly to NCB Financial Group, or NCBFG, well, the group would have reported an earnings per share figure of just about $2, well, just about 16 cents TT equivalent rather, per share in that half-year period ended March 2024. That's an 84% or 85% increase from the 9 cents TT equivalent recorded in that prior comparable period of half-year 2023. Now, net revenues from banking and investment activities were up just about 2.1% from 1.708 billion to 1.744 billion TT dollar equivalent. Overall, net operating income improving a very healthy 16.8% from 2.4 to just about 2.8 billion. Overall operating expenses not increasing as quickly, up 4.5% from just under 2 billion to just about 2.1 billion TT equivalent. Ultimately, net profit attributable to equity holders improving that 89% from just about 200 million TT equivalent to around $377 million TT equivalent. So certainly good reading for NCBFG holders at this particular point in time. When we take a look at operating profit contributions by NCBFG's major segments, well, we can see one notable standout, the LH&P segment, life, health and insurance, and pension fund management would have increased roughly 168% from 251 million TT equivalent in terms of contributions to operating profits in 2023 to just about 675 million. Wealth and asset management down around 66% from 153 to 51 million TT equivalent. General insurance also down 20% from 189 to 139 million. However, there was a 40% increase in treasury and correspondent banking from 194 to 275 million in that blue segment. And corporate and commercial banking relatively stable at around that $155 million TT equivalent mark. Now, from a value perspective, NCB is certainly one of the more interesting stocks to take a look at on the Trinidad and Tobago Stock Exchange, with a book value in those blue columns that has been relatively resilient over, since the fiscal half year of 2020, of about $2.37 per share. That has been bouncing around a bit, but is now currently at around $2.83 per share. So even with that relative resilience in the book value per share, we have seen a decline in confidence, perhaps, which is broad-based across the stock exchange, or TTSC, and the equity markets. We have seen that reflected in a decline in its price, reflected in a price-to-book ratio falling from about 3.6 times in that half-year 2020 period, again severely COVID affected, to that 1.1 time price-to-book ratio, which is currently the prevailing market multiple. So certainly, it appears that from a relative value perspective, looking at price-to-book and the book value of NCBFG, it seems as though there is some value or more value on offer for potential investors at this particular point. And when we look at NCBFG's book price-to-book ratio relative, or market-to-book ratio relative to the banking sector average, we can see that it is at the lower end, or somewhat relatively cheaper end of valuations at 1.1 times, together with FCI of CIBC First Caribbean, with First Citizens Group Financial Holdings, as well as RFHL trading at around 1.3 times, Scotiabank trading at that 2.5 time level, the banking sector average in terms of price to book at around 1.5 times. So certainly the banking sector looks a little bit cheap relative to their own historical individual stock levels and banking sector average levels. Will investors be encouraged to come and participate and add some of these banking stocks, including NCBFG, to their portfolio? Well, only time will tell. So at a price of $3.10 per share, well, NCBFG is trading at a price earnings ratio of 14.4 times, a bit above the sector average of 11.8 times, offers investors a dividend yield of 2.1%, which again is below the sector average of 4.2%. But from a price to book perspective, it does look relatively attractive compared to its other peers. So with relatively resilient banking revenues in mind, improved insurance results, and the resumption of dividend payments, importantly, Bourse is maintaining an overweight rating as part of the recovery story of NCB for the time being. Turning very quickly to GHL, for its first quarter ended March 2024, the group would have recorded an earnings per share figure of $1.01, which was an 8.2% decline from the $1.10 recorded in that prior comparable period. Now, net insurance and investment results actually declined just about 1.2% from 508 odd million to just about 501.6 million. Operating profits overall declining that 1.1% from 305 to 302.4 million. Overall profit attributable to equity holders declining that 8.5 odd percent from 255.7 to 233.8 million dollars in that first quarter comparable, quarter over comparable quarter period. When we take a look at operating profits for GHL by segment, we can see fairly cool reading in terms of its largest segment, LH&P Life, Health and Pension, declining just about 2.3 odd percent in terms of contribution to operating profit from 285.8 to 279 odd million. There was a 20 odd percent decline in property and casualty as well, from 62.9 million to 50.8 million. This was offset partially by improvements in that insurance brokerage segment, increasing from 25 to 31.7, or roughly a 25% increase, and a more than 30% increase in asset management revenues. Of course, these two segments being much smaller. Asset management in that green sliver increasing in terms of operating profit from 15.7 to just about 20.5 million. So some positives, some not so positives in terms of GHL's operating profit contributors. And of course, that is contributing to some of the earnings headwinds that the group continues to face from a value perspective, of course, with that material correction in price over the past few years. And similarly, with relatively resilient book value per share, currently at around $17.57, GHL is trading at that price to book ratio of actually a discount. So investors can actually snap up this stock at less than the book value of the share based on where it's currently trading at and its most recently released financial statements, again, as at the end of March. So at that price of $15.69, again, relative to the book value of $17.37 odd cents, there is that discount to the book value in terms of market price. GHL also offers currently 4.8% dividend yield, which is just in line, or pretty much in line with the sector average of around 5%. And it's trading at a fairly low price earnings ratio of 5.4 times, well below the sector average of 12.8 times. But with those relatively attractive valuations in mind, but perhaps some earning headwinds, particularly in what is forecast to be more active hurricane season, Bourse is maintaining a market leading rating on GHL for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com. And of course, you can check out all our research, which is absolutely free, at bourseinvestment.com. And of course, this article is in today's business section of the Trinidad and Tobago Guardian newspaper. So until next time, stay safe, happy investing, enjoy your Labor Day holiday, and we'll see you again on the Bourse Report.